So I want to thank everyone for coming to our panel discussion about the strategic implications of COVID-19 on biotech. We'll be recording this session, and a playback will be available shortly afterwards on the Locust Walk website. We'll also send an email to everyone who attended a link to the recording. We're going to focus on what steps companies can and should be taking from a deal-making perspective so they can survive to thrive. We have 1 hour allotted for the panel, including questions that I've prepared in advance, as well as questions received in advance from participants. If you have any questions you'd like the panelists to address, please submit them through the system, and I'll read out the most frequently asked questions, as well as ones that have the broadest applicability to the audience. You should be able to see that on the right side of your screen under the area called questions or chats. We'll be able to see them there. So I want to thank the panelists who've joined this discussion to share their views on what they are seeing in the market now, based on their experience from prior downturns, and I will introduce each of them briefly. So starting is Chris Ehrlich, Senior Managing Director and Global Head of Strategic Transactions at Locust Walk. He brings significant venture capital, business development, and strategy consulting experience prior to joining Locust Walk about 7 years ago from InterWest Partners, where he was a general partner. So he can also speak to the investor mindset from prior downturns. Chris is based in the Locust Walk San Francisco office. Brian Coleman is Managing Director and Global Head of Capital Markets at Locust Walk. He brings a career in investment banking and sales from bulge bracket banks, where he closed more than 800 deals and was most recently Global Head of Equity Sales at Jefferies. Brian is based in Locust Walk's New York office. And last and certainly not least is Tim Ehrlich, who is a partner at Gunderson Dettmer, the Locust Walk of law firms, where they focus on high-growth life science and tech companies and their investors. Tim leads their life science practice and is based in Gunderson's Boston office. For those of you, unfortunately, we couldn't get the video operating, but you can see pictures on the screen of Chris and Tim. And in case you were wondering, yes, they actually are brothers, but you guys can all be the judge of who is older and perhaps who is smarter. Now to the panel. So to get started, I'm going to kick us off with Chris, and I'll give you credit, at least within Locust Walk, of the concept of survive to thrive. So this will be a question actually for all three of you. What specific lessons can biopharma companies learn from the 2001 as well as the 2008/9 financial crisis?
So thanks, Geoff. Hope everybody can hear me okay. It's great to be here with you all, at least virtually in the new normal. You know, when I was on the venture side, the first day I got there, they told me that experience is what you get when you're inexperienced. And so I guess it's safe to say, having lived through now both the 9/11 and the 2008-2009 financial crises, what the experiences taught me was that the key during these turbulent times is really for biopharma companies to prioritize what's important and critical in their business and keep, you know, the most important programs, the most important team members, and the intellectual property all alive until you can make it through the uncertainty. And the goal of all this is to come out on the other side of the periods with kind of the key elements of the biopharma company intact. And that's the concept of survive to thrive. And I would say that from my home office armchair, it seems as if folks are heeding the advice, as I'm not hearing much about layoffs within biopharma companies, and I am hearing a lot about increasing your applications for grants and other non-dilutive sources of capital.
Got it. So I guess I'll ask the same question to Brian, since you obviously have a lens from the banking side over the last 25 years. What lessons have you learned from the prior financial crises?
Sure. Thanks, Geoff. I think the biggest one is that obviously, you know, markets are volatile short term, but they have a tendency to settle into a range. I think we've seen the last week. That's not to say there couldn't be additional news flow that turns the market downward, but ultimately, as people get adjusted, they assess their risk and they assess their needs on a go-forward basis, kind of stress testing their models. The biggest thing that I've learned in both downturns is the ability to have capital on hand or access to capital and be as liquid as possible. And at my prior firm, we kind of lived through that firsthand. I also think that just sort of realizing what, you know, the vendors that you use for your trials for sort of any business purposes usually get tested under a stressful environment like the one we're in right now. And I think it lends itself to multiple sources of vendor sort of opportunities on a go-forward basis, not putting all your eggs in one basket, so to speak. Those are my key takeaways.
Awesome. So Tim, you have a slightly different perspective. So what have you learned from prior downturns that the audience could take into account?
Sure. So, as a firm, we work with both investors, largely venture capital investors versus PE, and then, a huge range of companies, as you said, Geoff, both in the tech and biotech side. And I would say what we've learned both in 08, 09, and now is, fortunately, for many of the clients that we work with, this is it's not a bullseye like in 01 on the tech industry, on the industry specifically. It's a macroeconomic problem. And so for a lot of our clients, and the investors in the companies, they're in it for the long term. And so these sort of short-term blips or crises don't undermine the fundamentals of this business, which is investing for long-term, especially in biotech, which has much longer timeline horizons for everything for liquidity events. So, what we found is that the market, and we'll talk about a little bit more of this later, is that, the market doesn't necessarily, these kinds of problems don't destroy the market for private investing in biotech companies. The timelines may be extended, but the fundamentals of the business are still the same. And so, what we try to do is for our clients, for the companies, is to say, look, how can you be proactive about managing your resources, right? What are ways you can shift resources, where you can, minimize certain programs, focus on others, because there's really a flight to quality among investors, and your ability to raise new capital or extend your runway is going to be driven by their most promising programs. And so focusing on those most promising ones, ways and maximizing value to appeal to those investors who are still investing. And we'll talk about what we're seeing, on the ground right now in terms of companies raising capital. But I guess what I would say is, being proactive, managing your cash burn to get to the other side, focusing on your quality assets to appeal most to the investors. And again, it's sort of, being patient, because this isn't a bullseye on the industry that we all work in. It's more of a macro problem that, that will pass, and that, the fundamentals of our business are still strong.
Yeah, and if I can just chime in there, Tim, I mean, I actually think that as practitioners in the biopharma industry at companies or advisors, the silver lining, if there is one for this downturn, is that, we're going to save the world. And I think that there's going to be a newfound respect and interest in this industry. And I think ultimately there'll be positive externalities from what's an otherwise terrible situation. So hopefully some of these prior lessons could apply, and of course it'll depend on how quickly that recovery is. So Chris, getting back to you, drilling down deeper into this turbulent financial environment, it seems to piggyback off of what Tim said, that biopharma companies are torn between conserving their cash so they can survive to thrive, as well as taking advantage of the opportunity to enter into relationships, strategic partnerships at what appear, could be bargain prices, depending upon the situation. I guess, what advice would you have for companies facing this difficult decision? And maybe if you can kind of speak to that, like you did in the white paper that we put out, kind of by private company versus small public company, and perhaps even mid-sized public company, so we can tailor this as much as possible, how the company should react.
Sure, and I'm going to give you more feedback from what I'm seeing in the marketplace in real time today, rather than what I think the answer should be. So as I mentioned in my opening remarks, I am definitely advocating that in a turbulent environment like this, as Tim said, life science companies should think first about staying alive long enough to weather the storm. And I would say we're seeing many, but not all of our clients prioritize their spending on the most valuable programs in their pipeline. And I would say perhaps the best evidence of this to me over the past 10 days is that we've had quite a few companies come to us to ask us help spin out their non-core components of their business. We've signed up 2 and are about to sign up a 3rd, and are working on a 4th project where we're doing strategy to figure out how do we prioritize the portfolio. What dog food will the dogs eat? So having grown up during this era where there weren't a lot of IPOs, to me it's kind of back to the future for people who lived through the last downturn. So if everybody I talk to is making applications for grant financing, There's lots of increased interest in looking for non-traditional sources of capital, like Asian investors and family offices, and that's exactly what we advised all of our portfolio companies a couple of years ago. So that being said, as you point out, Geoff, for those companies that were able to access capital before this kind of new deep freeze hit, given that many prospective licensing and acquisition targets are available potentially now at discounted prices, if you're bold, and now is a reasonable time to selectively add these great fitting programs to your portfolio. And I would say literally in the past week, when I think about the calls that I've been on relative to existing and prospective Locust Walk clients, about 2/3 of the companies are in this sort of conservation mode, and the other third are looking to augment their portfolios through product acquisitions on the buy side. So I think the life is imitating art here.
No, it's interesting. I mean, just some more color from our side, which actually might be interesting for the audience to consider, is we are seeing some companies who are thinking about their options and their strategic help kind of retrench and say, you know what, I don't really want to spend money on this time. I need to get through the other side. I want to be careful with my spend, and people are shutting down hiring. But we're also, I think you would agree with this, Chris, we're seeing companies also continuing to put the pedal down and continuing to not just spend, but to kind of use the opportunity to make sure that on the other side of this, they're prepared, because there will be another side. Obviously, we can't predict it. But there's kind of two different camps about fear, and maybe not greed, but certainly fear and maybe future greed to be able to get the capital and the partnerships they need down the road. So it's interesting. And to your point on the buy side, there are several companies kind of in the 500 million to 5 billion range that are approaching us that are actually looking to do more now, which I actually find pretty interesting, that it's already spurring up some additional demand from some of the smaller companies, where I think the big companies already knew that this was their window to strike. Would you agree with that?
Not only would I agree with that, but I would add that, in this past week, two companies that I've been talking to are small-ish, albeit reasonably well-capitalized private companies. Actually, one's public, one's private, very tiny companies that, really should be in potentially conservation mode, but have been in discussions. Maybe they have in fact, both have kind of an existing license arrangement or a small equity position in something they're interested in, and called and said, you know what, there's a great opportunity for us to buy the whole thing outright. Can you help with that? So it's not just the big cash-rich pharmas. It's not just the big biotechs. It's, I think, across the board, which is why I find it harder to bifurcate between public, private, well-capitalized, and not. I think there's kind of bold and less bold relative to wanting to spend money and add on, and probably good to ask Coleman about his perspective on how investors might think about that, because a lot of those acquisitions have to be financed.
Yep, that's the next question. But I guess before getting to Brian, I guess what I would say is, for those of you who are in more of the fear/conservation mode, the time frame that we're seeing is kind of 1 to at most 3 months to reevaluate. We've had a lot of people say check back in a month or get back to me, in a quarter. So I don't think that people, and this is, I think, the good news of this is the optimism is that there's not this is canceled, we're never doing it. It's, we're going to check back. We might want to raise capital in a different market. We might want to try partnering in a different market, or we might want to figure out our strategy once we know where the bottom is. So I think companies are being cautious, but they're not being overly dramatic. At least that's what I'm saying. So Brian, on to you, relative to the investor side, kind of a broad question. What are you seeing out of the venture world and kind of the broad-based investor community, how they're reacting and how that's impacting capital raise?
Sure, I think, and we have several deals in the market right now, so we're kind of dealing with feedback in real time. From a venture perspective, I think a number of the firms have taken the opportunity to assess the risk for their portfolio companies and their current programs. Obviously, there's been a disruption in a lot of the trials that are taking place, and timelines are being extended. So I think they're trying to figure out what that looks like and what ultimately that will cost them in the way of additional capital to support those programs. And that's ongoing. I think that process, to your point just a minute ago, Geoff, probably lasts, a month. We're probably a couple weeks into it at this point, but my guess is it's probably another couple of weeks longer before things are sort of back on track and people have a better idea of what this will ultimately cost in the way of business disruption and additional costs to trials. The VCs that we have been engaged with on deals that have done some level of diligence or been involved in previous meetings have remained engaged with the deals that we have in the market. So we haven't seen any material impact or delay or cancellation at this point of those conversations. And we've been in front of two of the larger funds in the last 24 hours on a deal, and both are sort of operating as they would. Their view is that investing in private companies is a long-term game, and ultimately, yes, this is a crisis that needs to be dealt with, but ultimately the funds that they have that need to be allocated towards private deals are still there, and a number of them have raised recent funds that they need to put to work. So their perspective is to remain engaged in the market. It may take a little bit longer. For broad-based investors, obviously what we've seen anyway is the bar for quality is going to go up, and the diligence that's going to be done is going to increase. And so I think that just inherently happens in turbulent markets. People are looking for higher quality science, better management teams, closer to the potential public markets or an exit of some sort. So we've seen some of that as well. And then US investors, just generally speaking, we'll get into Asia somewhere down the line, but there's two camps there. People that are just holding off at this point, and these are mutual funds and hedge funds that dabble in both publics and privates. They've been spending probably a good majority, 90+% of their time on the public side, just trying to assess the risk and ultimately stabilizing those public investments. And then those that are ultimately continuing to look for new deals. And I'd say these are probably investors that are have pools of capital that are allocated completely towards private deals. So it's sort of a split down the middle for both VCs and ultimately for broad-based US investors. But we've seen continued demand from family offices, hedge funds, mutual funds, and VCs, but it really is on a deal-by-deal basis.
Got it. So I'm going to ask you to look into your crystal ball on the impact on overall deal activity for IPOs, crossovers, private financing rounds. It's probably too early to tell, but if you had to guess, I mean, how do you see the impact in the short term as well as kind of intermediate term on kind of volume and price?
Well, I think short term, we're going to see, like I said, an extension of people spending more time diligencing things and actually sort of assessing what their exposure is to an extended market like the one we're operating in right now. Valuation will matter. We've already heard that on all the calls we've had the last few days. I'm still interested, but my valuation parameters are a bit different today than they were a month ago. So I think management teams will have to be prepared to kind of think about where they are or where they were intending to go in the way of raising capital and the valuation associated with that. And in terms of my prediction, I think there's been a lot of calls like these recently and a lot of predictions thrown out, but I think we'll have some form of normalcy by summertime, and I would guess that some deals will move towards the finish line in late summer or early fall.
Yeah, and I think the interesting thing, and I'm guessing you would agree, is that we're still seeing deals printed. In fact, you know, your team led one at Locust Walk. I think it was last week that was announced. But obviously, those deals were not started in the middle of March. They were started probably in the end of 2019. So we might actually see a lag in the timing of deal announcements relative to deals that would otherwise kick off in this period. Might be less robust or might take longer. Would you agree with that?
I would, and to your point, yes, we were lucky to close the Series A round for Regency, a $30+ million raise. It was a syndicate split between U.S. investors and Asian investors, and we'll talk about that further on in the conversation. But yes, I agree. The deals that we're currently engaged with that have been in the market for a month or two, the demand and the interest still remains. But for those deals kicking off, it's going to be sort of a longer timeline and a harder ask on the front end.
So would you advise, and we'll talk about licensing, and Tim and Chris will chime in as well on this, and I'll get to you next, Tim. But would you advise companies to consider waiting to raise capital or start the process now, or how would you give them advice as to when to get started on a raise given the market?
Well, I think the reality of what we've seen in the deals that we've been involved with is it is a 6 to 9 month process. So planning takes some time, sort of pre-deal prep work, and if there's any commercial work that needs to be done ahead of time. So what we're seeing is a lot of companies that are planning for capital raises to kick off kind of midpoint of the year, but they're engaging us to get their deck in order or do some form of commercial work to be prepared. We're also seeing companies that are considering not just a single track process of raising capital, but ultimately, to Chris's point earlier, sort of incorporating a potential partnering process or a strategic process as each takes time. And I think in a market like this, management teams, our job is to create optionality for them. And ultimately, I think it's a structure that we'll see more of.
Got it. Makes total sense. So Tim, you have a pretty broad lens. You and your partners do a ton of partnering in M&A. You do a lot of private financing, capital markets transactions. So you're kind of representing a much higher flow just from the legal side. But are there any trends that you're starting to see on deals, whether it's specific terms, behavior of counterparties, or anything that is notable for the audience to know about and consider when they're doing deals?
Yeah, sure. So first of all, I would say that I agree with what Brian has been talking about. We're seeing the same thing in terms of deals that were started beforehand, financings and transactions are still closing. It's almost like you think of all the financing work as a battleship and you try and stop it. It's not going to stop immediately. There was some fear that things would just stop and deals wouldn't close, but by and large across our firm, and we do more venture financings a year than any other firm in the country, we have not seen a significant drop off in venture financings closing. In fact, we've closed, several in the last week and others that are ongoing and upsizing rounds. So it's almost like a tale of two cities. If it started before this crisis, it's almost like business as usual. And I agree with Brian and Chris that if it hasn't started yet and you're just starting to think about going and raising capital, that it's going to take longer for those initial meetings to get started, and the process will definitely take longer. So we are seeing deals close, both financings and strategic transactions, provided that they started the discussions well before. We just did one that was announced today for Teneo Bio. My colleagues on the West Coast did that. We've got a couple others that are going to be announcing. So in terms of deal flow, we think there may be a slowdown in terms of deals as those ones that were started, sort of close out. But we are seeing financings closing. I would say that what we're starting to get are questions both from acquirers and parties to transactions. If you think about it from a transactional side, people are starting, not surprisingly, looking at force majeure provisions. When I talked earlier about being proactive rather than reactive, a lot of clients that have contractual obligations to vendors, or they are vendors, and they've got obligations to companies, they're looking at the provisions in their contracts to see whether this kind of global health crisis constitutes a force majeure event that allows them to get out of the contract. Are there other contractual bases that allow them to stop performance? And we actually put out a client alert on that. Force majeure provisions are not as straightforward as you'd expect in every case, and they're different, and you have to look at the language. But people are starting for sure to look at those and saying, if I need to extend my cash runway and I don't want to pay my vendors what I'm otherwise contractually obligated to do, how do I manage that? Do I have a contractual right not to do it? And then as a sort of a practical matter, courts are closed. Most courts are closed. So even if there was a contractual breach, how do you even enforce it? And so we're having a lot of discussions with clients on both sides, both sell side and sort of buy side, about whether or not these contractual obligations are enforceable and are a benefit to them. You're also seeing people starting to look at MAC clauses and MAE clauses for transactions that haven't closed, or financing that have a tranche mechanism that have an MAE out, and whether or not these circumstances could constitute, a basis for an investor or an acquirer not to complete the transaction or fund a tranche milestone. So we are, and like I said, in every case, those things are different and fact specific based on the company. And anyone who tells you that there's sort of one universal definition of MAE or force majeure, and therefore this does or does not, the situation does or does not apply, it's probably overstating it by quite a bit. You have to look at the specific contract language and also the specific set of circumstances and which side you're on of that clause to determine whether or not it helps you or hurts you.
Yeah, so it'll be interesting to see if viral pandemic is a definition of force majeure. I've heard a lot of chatter on that.
It is, well, many of them do say epidemic, actually. So some do and some don't. And which state you're in, it even depends on, there's a difference between, based on state law and whether or not they would, we would use, or if it's not written into the contract, whether or not they would imply it into the contract. And it also depends on whether you're like a payment, for example, the ability to make payment is not, a pandemic is not a basis to withhold payment unless the banks are closed and payment mechanisms are shut down. And many of our clients are hoping that there's an opportunity to say, well, it's a pandemic, I don't have as much money, and therefore, it's an act of God, I shouldn't have to pay you. And just, by way of example, most courts would say, look, unless the banks themselves are shut down, just because you have less money or you may have less money, that's not a basis not to pay. In addition to many contracts actually specifically carving out payment obligations as a force majeure event. So, or as a, something that's relieved of the obligation.
Yep. So Tim, one real quick follow-up before I move on. You probably have some pretty good insight into IPOs that are in process but are not yet launched. Have you any chatter from people, bankers, companies, or otherwise about whether or not people are going to delay, or are they still pushing forward, assuming that in 2 to 3 months the world will be back and it'll be business as usual?
Yeah, they're being, so I actually have very, like, as of daily inputs on that. It's a great and timely question. So what I'm sort of like we were talking about the private financing, for companies that were looking to go public following a crossover round, who had it in their sights already, they are moving forward. I mean, bankers are still, people are still filing S1s. I believe there are a couple of biotechs that are going to price this week, amazingly, or in the next several days. And so, they're going forward as if nothing had changed, really. And if they're not going out, they're being very opportunistic. So they're getting their confidential S1 filings in, and they're ready to go as soon as the market opens up. And what I've heard is that there's a possibility that there's an opening in June. And if not in June, then perhaps September. And they want to be ready. And so if companies were fortunate enough, I have a couple clients who were fortunate enough to, raise that large crossover round or a crossover round with the expectation of going public at some point in the next 9 to 12 months, they are getting ready and moving forward. So from that perspective, the banks are telling them, look, there may be an opportunity to go out once this settles, and you should be ready. They're not, what I'm hearing is they're not talking about the end of the biotech IPO market at all, and that there are still opportunities to get out even this year, which was surprising to me, but that they were saying that, but that's what I've heard so far.
I think that's consistent with what we've seen as well. So switching gears a little bit to Chris, and so what is the best way to seek a strategic partner when the capital markets are choppy? Just playing back when Locust Walk was started in the fall of 2008, the word IPO just was. It was a foreign word. No one knew what it was, and that's all people had to raise capital. But I'm curious what your take is on how to do it in this market.
So I'm probably a little less upbeat and optimistic than my other colleagues here about the robust return of low cost and easy access capital. And so I think that based on my experience, people are going to spend much more time on the strategic side or in some sort of combination side. So I think without having the BATNA of easy access to capital, biopharmas who are seeking outside capital from partners have to follow a couple of steps to boost the probability of getting these deals done, or one or more of these deals done. So I would say, first of all, be less aggressive in terms of what we call kind of the 3 T's: your tone, kind of the terms of these deals, and the timelines. I think, based on my experience, partners realize, they read the news and see TV, that people don't have as many alternatives, and that they're much less likely to be able to be pushed to move quickly or to actually boost their terms if they know that companies have limited options. So, I've been through scenarios where we'd say, listen, if you don't, boost these terms or hurry up, we're going to go public. And it was a credible threat, and you had bankers and things were going down. And I think today it's a little less bold and a little less aggressive in your ability to do that. So I would say also, it's really important to create deal tension. We have a lot of people coming to us on to kind of negotiate one-off sell-side opportunities, someone who's expressed an interest. I think that's both from an offensive and a defensive perspective, kind of a challenging approach. And we would recommend reaching out to, as many prospective partners as possible and running a process just to make sure your deals actually get done, if not to maximize value. And third, I think something Brian's going to talk about as well is now is a really good time to think creatively about how to mesh kind of strategic and financial investors into these same syndicates. So, we have a couple of deals in the marketplace now where, the interest has come from a large potential strategic partner who said, I could do a deal with you, or if there's a financing coming together, I could participate. And that serves as a very interesting catalyst and source of diligence and a check mark for financial investors who might be hanging around the hoop to coalesce. So my guess is that we're going to see more creative deals that look, if their financings come together with combinations of kind of corporate investors as well as financial investors.
So let me summarize what I heard there, and then I'm going to pass it over to Brian, who certainly is more of a capital market bend. But in 2008, there was no IPO, or frankly, the venture market was much smaller. Family offices were not as involved. The Asian money was practically non-existent. And so it was a single track process where you try to reach out to partners, get capital if you could, and that was how you lived to fight another day. And of course, there were venture investors, but it was not as robust, certainly. Now, what you're saying, from what I heard, is that all the lines of who is who and who is what is blurring, where you might have capital coming out of Asia, but I'm putting this words in your mouth because we've seen this, but they also want a JV as part of that. So they'll invest, but they'll also take strategic rights. Family offices will put money in, but you might also have a strategic put money in who may or may not want rights, and all those things to get capital, whether it's equity or asset-based, is kind of now on the table versus 3 months ago, 12 months ago. The propensity for people to want to do partnering, how would you say that was compared to now? Before, I don't want to answer the question for you, but I'm curious.
No. So it's a very interesting point. The reality is, kind of, I'm a vestige of my own past. When you're absolutely right, that in 08, 09, private deals were done by private venture guys, of which there were sort of 20 meaningful funds. And if those funds kind of shut down and got aggressive, then you really had a difficult time. The only choice was to go seek really, really orthogonal sources of capital. Very few people went to Asia. Very few people, family offices didn't really exist on a wide scale basis. And so it's a different ecosystem now, and I think that the only advice I can give is that companies should look at all options as possible, because you don't know in the continued uncertainty, whether a partner's going to have leverage, whether an investor is going to come in or shut down, and so we're looking at triple tracks in some cases. I'm putting out 3 statements of work for one company today and 3 tomorrow. Let's look at partnering, let's look at fundraising, let's look at reverse merging, to keep the options on the table.
Yeah. So to kind of get a little bit more color in addition to that, I would say 12 months ago, the majority of the things that came across our desk were relative from partnering to financing, would skew more towards the financing side. And I think there's a lot more balance on that, and especially of interest on the public company side, where you actually have a stock price on a day-to-day basis, and there's less interest in raising capital when stocks are low, prices are low, and so they're coming to us looking for partnering, which is, I think, something we hadn't seen, at least I hadn't seen, since early days of Locust Walk. So Brian, I'll pass it off to you to get your take on kind of the multi-track process and how do you think about partners versus capital markets?
Sure, thanks, Jeff. I mean, part of why I joined Locust Walk was essentially the ability to tie in all the different facets of what Locust Walk can offer into a process. My background is 25 years in investment banking, and that is, for all intents and purposes, usually a single track process of taking companies public. On the private side, I think the job of any advisor is to create optionality for the companies themselves. And in a stronger market where financings are sort of the key focus, to Jeff's point earlier this year, those were a good majority of the conversations we're having. We're still having conversations around financings, but it's also married with, to Chris's point, the thought process of what else can we do creatively? Can we potentially look for a partner? Can we look for a strategic? We've got a deal in the market right now that ultimately we were dual tracking with a financing and a strategic process, and it ended up that the strategic ultimately wanted to put in for 25% of the financing as opposed to formalizing a strategic process. Now that could be a function of sort of a step function into an ultimate acquisition, or it just could be a change of thought process. And we seem to be seeing more of that from strategics, considering both sides of the equation. And I also think that the key thing to think about in the market we're in right now is decision making for companies in this market. You know, there isn't a luxury to wait. So you can't spend 6 months on a financing and then consider a strategic process or a partnering process. Things just take time. And I think sort of understanding what your options are and how strategics are thinking about it, even if that's not your number one priority, it certainly always helps to have that information to be able to sort of leverage that into the discussions around the financing.
Yeah, and I'll close this piece with an anecdote that basically helped convince me the need for Locust Walk Partners in the fall of 2008. Is we tried, when I was at my prior biotech, that actually Tim was our legal counsel on, so we've known each other a while. We tried to do a sell-side process with a bulge bracket bank, and were not successful. And then that was the fall of 2007, and then subsequently in the spring of 2008, we tried to do a capital raising process with a specialist bank. You know, both of these good brand names, but we ran into a buzzsaw in the spring of 2008 and into that summer, which was just never going to happen. And one of the takeaways I got from that is if we would have done the dual track M&A / partnering in parallel with the capital raise, we actually might have been successful, because you can't predict the market. No one could have predicted this was going to happen a month ago. At least I certainly didn't. And so, but if you would have done a dual track, to your point, Brian, from the beginning, rather than waiting and doing it in series, which is technically not a dual track, that's a single track, just in series, your odds of success go up because you have more shots on goal. So that's kind of food for thoughts for everyone. Switching gears a little bit, Tim, relative to the investor world, VCs, as you know, they need to raise money from, even they have bosses, believe it or not. They have limited partners who have to put capital to work in their funds, and these investors need to put money into private and public companies. I guess, in your experience in today in the market, what's going on in the LP market? Are the VCs raising capital for new funds? How is that market reacting? How do you anticipate that will impact the future availability of capital for venture investors? Because recognizing, as I'm sure everyone knows, there's a lot of money that's been in the system, but it's going to take, that's going to filter its way through, and then there might not be enough at some point. So I'm curious what you're seeing in the LP VC world.
Sure. Yeah, well, so thanks, Jeff. That is a huge part of our business at Gunderson Dettmer, is representation of venture capital funds on the fund formation side, and we actually work with about 450 different funds. So we have a pretty broad perspective on what's happening in the VC fundraising, capital raising market. I'm sure many of you saw, just as an anecdote, that Flagship and Arch just closed above $1 billion funds and were announced today. So what we are seeing is that on the formation side, things that were in process, where the deal documents were out, they had rounded up, LP interest and were heading towards an initial closing, are still closing. In fact, we've seen a sort of a surge in activity where, not surprisingly, funds that wanted to do their initial closing are pushing folks to really get the documents finalized and get it all done as soon as possible. And I should have mentioned that on the financing side, we're seeing the same thing. So people are saying if there was still some uncertainty, they're looking to try and close those things out very, very quickly. For those funds that were out, marketing and just trying to raise interest and fundraise to LPs, those have gotten pushed way out. So if there were funds that were planning to come out in Q2, it's now been sort of automatically be pushed out to Q3, at least initially, and then we'll see what happens if things continue. But there's definitely been an impact there. For the funds that are collecting subscriptions, so they were sort of aiming for first closings in April or May, we're seeing that a number of those funds are hesitant to nudge their investors, and so they're being a little bit more passive because they don't want to encourage people they don't want to push them so much that they choose to leave. But they're, until they're still heading towards those timelines, but our expectation is those might get pushed out a little bit. But at this point, we haven't seen a rash of LPs pulling out or withdrawing from closings. We have seen a couple of high net worth family offices do that. For example, their signature pages were held in escrow, ready to fund and wire for the first closing, and they've come out forward and asked to be removed from the closing. But I'd say that's certainly in the minority. We're not seeing a rash of that, and that's mainly on the family office side. On the institutional side, almost not at all. We haven't seen any LPs. Again, this is anecdotal, but we really have not seen a trend of institutional LPs pulling out, and it's been limited to a small handful of family offices. So overall, the fund work, I'd say if you took a snapshot across our whole portfolio, funds are getting closed. They are raising capital. Biotech funds in particular, they're still raising lots of money. They're hitting their investment goals. We just closed a fund 2 days ago. There was over $200 million second fund, and these things are happening on a daily basis, as we've seen in the news. So I foresee that there will definitely be capital to be deployed as soon as people are willing to open up their wallets, in the summer and the fall. I mean, my expectation, quite frankly, is that there won't be a summer. There won't be a summer slump. I think that once this stuff happens, and if we're released from our lockdowns in May/June, I foresee that people are going to try and ramp up as quickly as possible, and so we might see a flood of activity and capital being deployed for funds that are closing now to try and start deploying capital in the summertime without sort of the slowdown that you'd normally see, because there's going to be a lot of pent-up demand and people just want to get stuff done in the remaining 7 months of the year. So again, lots of activity on the fund side. Funds that were in process are still closing. Not many, if really at all, institutional LPs withdrawing, and it's mainly sort of limited to a few small family offices.
Yeah, it makes total sense, and I couldn't agree more about. Unfortunately, not having a summer vacation, and while we're all in our homes, I wouldn't really call this a vacation, but this is it is causing a little bit of a backlog, and I think people will be ready to roll, hopefully, when they get to the other side of this. So there's actually been several questions in the chat about this, and we actually had this as a prepared question as well, but I'm going to call slight audible on it, and it has to do with the extraordinary response that our industry has pivoted in pretty much overnight, which I think is unheard of in drug development world, to take products that might have been used in cancer, in any number of fields, autoimmune, and all of a sudden everyone's a COVID-19 company, which some of it is, I'm sure, not 100% really viable or kosher, to use maybe a different term, but there's a lot of merit to a lot of the things that are happening here, from vaccines to therapeutics, diagnostics, etc. So I'm curious, maybe Chris, if you want to take this one. A, what do you think about this from what's going to end up shaking out? B, if you're a company that has a product that could be repurposed here, are you potentially going to be squandering precious capital and time and resource on something that might not ever come to fruition, or is it worth the gamble? Do you stay the course? How do you think about that? And maybe give some advice to the audience.
So that's an awesome question, and I don't think I know the answer. I'm actually curious to hear from Brian and Tim their take on it. But what I'll tell you is that if I look historically, the best reference point I can look at is kind of post 9/11, when brand new biopharma companies were created to address the threat of biowarfare agents like anthrax, and the idea was U.S. government kind of VIP the process of advancing the drugs and vaccines to market. They would guarantee purchases through stockpiling. And so it sounded really good. And for a variety of reasons, by and large, those efforts did not pay off. And my observation is that, the model of creating for-profit companies to address kind of existential threats failed for a couple of reasons. First, in this case, the threat they were trying to treat or vaccinate against diminished. So if not in actuality, then certainly in perception. No one today walks around, concerned about anthrax. Second, back then there were so many different kinds of biowarfare threats that many companies' efforts were really diluted and less focused. I would say the case is different here. In the case of COVID-19, this looks like it's going to be a really long-lasting threat and have global penetration. And so if we look at the timelines for companies repurposing existing drugs, or frankly, developing new ones that may not be, in the clinic until next year, there actually will be probably, in my opinion, a market for those. And so we are actually encouraging companies we're working with to both repurpose existing assets and reprioritize the platform efforts to explore the potential in treating and preventing COVID-19. Now, whether that will be interesting to partners, I can tell you we had a call yesterday where a large company expressed interest in giving research dollars to test a company's assets. So I believe on the strategic side, there'll be interest. I'm curious from Brian and Tim if they think that investors, will find this an interesting tact and that will pay off and allow them to raise more money.
Brian or Tim, do you have any insights there? I have some thoughts, but happy to cede the floor.
Well, the thing that we've seen with one or two companies that we're in discussions with is, if they have a technology platform that can help move a drug forward, using the FDA fast track process with COVID right now is an excellent opportunity to advance their programs under a sort of a quicker scenario. Generally speaking, investors in 2008 and the like, there will be a short-term phenomenon for people looking for companies or investments that require less in the way of sort of formal trials and broad-based trials, and we'll talk about that in a little while. But I think to the extent they can limit their exposure to the negative impacts of the market and focus in on opportunities and fast track things, I think everybody is sort of assessing their platform right now to see if they fit into that bucket. But I don't know if Tim has a different thought.
Yeah, well, I would just add, not necessarily a different thought, but what I would say is it's definitely the sort of flavor du jour, and a lot of companies that I'm working with are doing it for almost because it's the morally correct thing or the ethical thing to do. If they can help, they will try to, but for some of them, it's really more of it's sort of a poking at the problem rather than a complete reshifting of resources. Some of the early companies that are saying, hey, our platform could be used for this, they'll mention it in pitches to investors, but I don't expect, because they're so far away from anything that could be actually meaningful, I think that is more of a nice to have rather than I don't think investors are really looking at that as huge value creation. What I would say though is that companies which, if you look at some of the pronouncements, actually Bob Nelson had a really good comment today from Arch, had a good comment in the press release about the new fund, is he said, one of the good things is, Geoff, you were saying earlier, one of the things that may come out of this, which could be really great, is that there will be more focus from investors on companies and technologies that can address this kind of issue, global pandemics and health risks, anti-infectives, bacterials, vaccines, et cetera, and sort of looking at this market generally and companies working in this space as something that could have a huge impact both economically and globally from a health perspective. So whether or not the companies are focusing specifically on COVID right now, you may or may not have a direct impact on their ability to raise capital. It's certainly something that people may notice, but I don't think in the long run it's going to dictate their value. But what I do think is that investors will be looking at companies that they may have otherwise bypassed, like vaccine companies, for example, on the basis that they were not good investments, and refocus on companies in those spaces. Companies in those spaces will have more opportunities for capital, in part spurred by this occurrence, right? Because this is probably the first. This is not the last at all. I think everyone assumes there will be other events like this, other viruses that, you know, people who are focusing on now that we don't even know about. And so that's how I think about it is, you know, if you've got a platform that can be used to address these kinds of issues, whether it's COVID specifically or other ones that might be lesser well known, that you have an opportunity now to get, you know, meetings and investment potentially from a wider swath of investors than you otherwise would have. So I certainly wouldn't, you know, I would for our clients, like, you certainly wouldn't give it up, and if you can use it in that way, great, but I wouldn't assume that that's going to win the day.
Yeah, no, I would probably echo all that. A few maybe additional points to add, especially from things that we're seeing from private companies. It's going to take too much time to raise money if you're a private company, if all of a sudden your pitch dramatically changes to you're a COVID company. By the time investors are potentially maybe perhaps interested, this thing might have the acute phase move on, and then the investor interest might not be as robust. So for a private company, I think that's probably not a smart move to pivot to this. If you're a public company and you can pull the trigger on a capital raise quickly, I think that is something to consider. I think the one time you might want to do that is if you have a clinical stage asset that you can repurpose into a trial pretty much immediately, and that capital can go to fund that trial and get a near-term result and potentially compassionate use or near-term approval. That is actually a material value creation event if you can pull that off and if you believe it actually will work. So I think the answer is it depends really where you are in development, whether you're private or public. I don't think you can just dip your toe in this water and say, hey, we're doing this COVID thing as well as this, because you're not going to get the attention. Because frankly, there are companies that are pouring billions of dollars into this, and they're going to come out ahead, and not everyone's going to win. There's going to be a lot of losers. I mean, do you really want to come out with a competing vaccine to J&J and Moderna, for example? Maybe if you're Sanofi, you do that, but certainly not if you're a small biotech company with limited resources. So if you have an approach that's different and no one is working in that way, that might be something to consider. But again, I think there'll be more losers than winners, and people see a pot of gold at the end of the rainbow, but that pot is going to continue to shift, and I think most people will never actually reach it. That's kind of my soapbox that I will now get off of. So just one other thing I wanted to make sure we touched on. There was one question in the audience, but Brian, you mentioned earlier that the financing that recently closed had investors out of Asia. Obviously, China is where all this began. So how was it that we can get, or you got, or the company got investors out of Asia to deploy capital, and how are you seeing that evolve? Are they interested? Are they open for business? Are they looking for partnerships or capital or investments? How do you think about Asia?
So the parties that we deal with, Geoff, they're absolutely open for business. I would say there was some disruption early on. I mean, they're essentially, for all intents and purposes, several months ahead of us in terms of the pandemic. I think the other topic in talking to an investor yesterday is, you know, their economy is industrial and manufacturing based to a large degree, and our economy is a consumer based economy. So the disruption in business is going to impact them a little bit different than it would here in the States. But our experience in closing the deal last week, which, as I said earlier, was 50%, a syndicate made up of 50% investors from Asia, is for the last, call it 4 to 5 weeks, it's been business as usual. So they're back to business, they're engaged, and they're anxious to look at new deals. And we've got another deal, hopefully, that we'll be launching here shortly. And there's already interest in it from a number of groups in Asia. So the network of investors that we've built, a lot of them have LPs and ultimately U.S. denominated funds here in the States. They also have funds overseas, and we've had to go through the ODI process, which takes a little bit of time to essentially get sign off from the Chinese government. But all that being said, like I said, we had success on Regenecy. I think the other piece is for companies just to be open-minded. Part of some of the negotiations we've had with other companies and Asian investors is the opportunity to set up a joint venture for rights in China in particular, where the company's willing to put up money to fund an entity like that. So I think part of getting investors in, especially in a challenging market, is just having an open mind and really thinking about your options from top to bottom.
Awesome. So before we conclude, I have one final speed round that I want each guy to answer in 20 or 30 seconds or less. I would like to end on a positive note since there's so much gloom and doom. And if you guys could each share briefly one positive that you think will come out from this whole situation. It relates to the biopharma industry. So go for it, Chris. You go first.
So I think you said it earlier, Geoff. I think the idea that biotech and biopharma, which has been an important aspect of ingenuity in the U.S. for a long time, and was under a lot of pressure as an industry that seemed to price gouge people and maximize price rather than benefit human health. I think a lot of those arguments are going to become muted, and I think there'll be increasing respect for the biopharma industry and its ability to innovate quickly and really keep people thriving and surviving more than ever before. And the idea that we all get in this business of kind of trying to do well by doing good is going to be renewed, because the purpose that we face every day we're suffering here is to try and actually help people, and the companies we're working with are actually doing that. So I'm actually really optimistic for biopharma.
Awesome. Brian, 20 seconds.
Sure. I think what's been really encouraging is the level of communication and teamwork that has occurred not only at Locust Walk, but all the partners that we're working with, investors and companies. Everybody's open-minded. Everyone's looking for additional input. We're all trying to figure this out together. And I'm encouraged by a lot of the conversations we've been having with investors about what this all means for the second half of the year. So all in all, I think we'll see better days ahead.
Awesome. Tim, final comments, 20 seconds?
Yeah, Chris sort of stole my thunder, typical older brother. But I was going to say that if you look at, where kids coming out of college and graduate school used to focus their energies, they first in the 80s, it was banking, and, in Wall Street, and then it was, tech, and working for .coms. I foresee that coming out of this whole crisis will be a whole new wave of really, really bright, ambitious young people who will view the industry as, the place to go, to focus their energy in a way to change the world. And I think if we have, in addition to the sort of positive glow, hopefully of the industry as a whole, you're going to be having a rash of, in a good way, of innovation that is driven by this young group of people who are, instead of going to tech, maybe view biopharma as a place to now build their career, because they see this as a global need and one they can really make a difference. And so that could unleash an enormous amount of new innovation, which would be great, I think, for everybody as well, from a health perspective and economic perspective.
Awesome. Well, as you can see, the Ehrlich brothers are never short of words when asked. But we are out of time now, so I appreciate everyone joining us today. As a brief reminder, the recording will be posted to the Locust Walk website and will be sent to each of you via email. We will also do our best to answer in writing everyone's questions that were submitted, so do not fear. So in conclusion, please stay safe, social distance, and continue to do the great work that you and our industry does. So thank you for joining.
Thanks, everyone.